All right, Jorge, we are ready to start.
All right. Welcome to our next workshop of the day at the Home Show and Expo here. Remember that please mute yourself. And if you have any questions, please post it at the chat and then we'll do that with our presenter. We give it to her to answer those questions for you. And having said that, we also have a visitor here. She's going to talk to you for a couple minutes. His name is Odalis Barrio with the Homeownership Program in Arlington County. Go, Dallas.
Hello, everybody. My name is Odalis Barrios, and I'm with the Housing Division Home Buyer Programs. So I want to tell you that you can use the Arlington County programs to purchase just home in Arlington. And then I just want to direct you to the website, which is the Arlington County Housing Division, where you will see a lot of information about the home buyers program. We have the MyPad program, and we're also going to have about 8 brand new condominiums coming up. And then please go to visit this page and the website, the Arlington County. You can call me if you have questions at 703-228-3793. And this is my direct number for any information regarding home buyers in Arlington County. Thank you. Back to you, Jorge.
Thank you so much, Odalis. And remember that the Housing Division has a landing page here as an exhibitor with a lot of information, not only about home ownership, about rental, about affordable units, and what we are doing. Okay, so now we have with us Liz Ray. She is with Burke and Herbert Bank. I want to thank to them also for being exhibitors. If you want to go to the landing page and find out what they are offering, please go there. So with that, Liz, please take it away.
Thank you very much. Good afternoon, everybody. Thank you for joining me. My name is Liz Ray, and I am one of the lenders at Burke and Herbert Bank. I work in the consumer lending department, and today I will be talking to you about various ways to finance a home renovation. A little bit on Burke and Herbert Bank. It is the oldest bank in Virginia, established in 1852. And our claim to fame, if you will, is that we are a community local bank. We have over 20 locations throughout Northern Virginia, and we are currently expanding into Fredericksburg as well. We offer a full range of banking services, including home mortgages, home equity lines of credit, and I will go further into those and explain the various products that Burke and Herbert Bank offers towards the end of the presentation. For my presentation, I will focus primarily on different products as a whole. So they are applicable to any bank, and then we'll focus on what Burke and Herbert Bank offers towards the end. What we're going to cover is first we're going to speak about why renovations to your home are so popular right now, what is going on in today's market to make the homes sell faster and for a higher amount. Why you might be using the equity in your home, other needs that you may have. We will talk about what a home equity line of credit product is, the benefits of obtaining a home equity line of credit and the various uses for one. And we'll talk about alternative lending, such as refinancing your mortgage, getting a mortgage cash out interest loan, and home renovation loans. And at the end, you will have an opportunity to ask any questions that you may have. Thank you. So what is currently happening in the marketplace? Over the past 12 months, even more so, we have seen the effects of the pandemic, and we have seen more and more people staying and working remotely from home. We've also seen kids attending school remotely and families staying grounded as opposed to traveling or something like that. So one of the benefits of renovating your home or financing a project is to make yourself more comfortable in your home space. We'll talk about that a little bit later on. Something else that we have seen is a very high demand in Northern Virginia for housing. There are not as many homes available for sale, but there's an influx of people coming into this area who are looking to purchase a home. So what we're seeing currently is the value of the home rising, increasing, and the demand increasing. So the amount that you can sell your house for is also at an all-time high. Single-family homes have a monthly median sale price of over $1 million for the first time. So the average home in Alexandria City actually sells for $1.16 million currently. Here's another example. Here's another example in our area. These are figures from last month. So in the DC metro area, for example, the average home sells for $497,000. Why home equity lines of credit and mortgage refinancing loans are so popular is low. What that means is that the interest rate that you are getting for an average loan is at the maximum low that it has been in over 10 years. So to put it in perspective, in the 1980s, if you were to obtain a mortgage, let's say your mortgage would be for $300,000, but you would be paying an interest of 18% on that. That was at its high. About 10 years ago, those interest rates were anywhere between 6 and 8%. And currently, if you obtain a mortgage, your interest rate will be around 3%. So why are your neighbors renovating? You may have seen some homes. I know in my area, there are plenty of homes that are building upwards. They're expanding, doing huge renovations. And a lot of folks are also doing renovations inside their home on smaller projects. So why is that? Well, over the past several years, popularized doing yourself renovations in the home. So it's something fun for the family to do together. Now, you might also be thinking about a larger project, and it's great to engage with contractors to help you on your path to renovate your home in that sense. But really, there are multiple reasons to renovate your home. One, as we were talking about the demand for homes, you might want to spruce up your house and finance a couple of renovations in order to increase the sale price of your house when you are ready to sell it. And if you're not planning on selling your home, but you are working remotely or your kids are attending virtual school, you might want to expand your space and just make it a little bit more comfortable for yourself. Some examples are to build a home office, or maybe that extra sunroom that you've been thinking about to enjoy your home a little bit more. What we're seeing today is a lot of renovations that increase the value of your home. So just to give you some examples, these examples are from, again, April of 2021, and these are projected costs based on the MLS monthly report. MLS is a database used by real estate professionals. And what these slides are going to show next is a projected cost of a renovation versus the cost recouped. So if you were to do a minor kitchen remodel, it would cost you about $26,000. However, when you were to sell your home or to get your home appraised and then sell it, you would recoup about 75% of that $26,000 that you invested in the kitchen remodel. So you might be as well be comfortable, enjoy where you're living, and then reap the benefits of getting that value back, the value that has increased your home's value. So for a major kitchen remodel thing, get all new appliances, it's about $75,000 currently, and you would get almost 60% of that cost back when you were to go sell your house. Or if you wanted to obtain a loan, you would need to get your home appraised, and that would add that additional equity into your house. Another one, probably the most expensive, one of the most expensive renovations to your home master suite addition. That job costs approximately $161,000. Now, all of these figures are pertaining to the Northern Virginia area. And out of that $161,000, you would receive almost 58% of the cost recuperated back in the value of your home. You're thinking about a bath renovation, $1,000, and you would see almost 60% of the cost recouped. And if it's a new addition, it's around $60,000 currently. Roofing replacements, everybody needs their roof replaced at some point. If you're thinking about doing that, the average job for a roof, again, it depends on the size of your house and things like that, is approximately $30,000. But when you go to sell your house or continue living in it and get it appraised and get a loan against the equity in your home, the cost recouped would be 64%. For something on a smaller scale, not a minor job. Any renovation to your home is cost about $16,000 to put in. I don't know about that. I think maybe you could find a little bit of a lower cost, but the cost recouped would be 72% of that value. So you're just putting value into your house if you're thinking about doing some sort of renovation. Now, additional benefits to having equity in your home. So the equity in your home, let's back up a little bit. The equity in your home is how much the house is worth in today's market. You might not realize it, or maybe you haven't thought about it, but if you're in this Northern Virginia area, you have equity in your house, and you can take advantage of that equity and get a loan against the equity in your house to finance other things. So on here, I just have some examples. If your kids are at home and you want a safe place for them to play, to put in a pool, you could use the equity in your home to do some landscaping. That was very popular at the beginning of the pandemic. A lot of Home Depot was thriving, actually, because a lot of people had nothing else to do except garden. You might be working from home for the foreseeable future, so you may want to add in a home office or an addition, because now your entire family is spending more time at the house. And there are other items that you can use the equity in your home for to purchase or to finance. So some other ideas is you could get a loan against equity in your house and use that to pay for your kids' college tuition. You could consolidate debt. So currently, credit card interest rates are probably higher than what you would get from a loan that is secured by your home. And right now, since the interest rates are at a historically low rate, it would be a great time to consolidate that debt. What it would mean is you could pay off all of your credit cards, let's say they're at 20% interest, consolidate it into one, and then be paying much lower interest so you can pay off your credit card debt faster. An example would be you'd be saving about 17% in interest monthly. So that significantly reduces your payments. Another use for a loan against the equity in your home is to purchase another property, a second property. I've seen this happening again during the economic climate with the pandemic, where people can't travel as much, and maybe that's starting up again, but there are still families that want to take a vacation or go somewhere together in a safe way. So I've seen folks purchasing second homes just to have a getaway for their families. Another very popular use for a loan currently against the equity in your home is a bridge type of loan. So because the demand for purchasing homes, specifically in our area, is so high, if you go to purchase a home, if you're thinking about purchasing one, it's tough to compete with people who have cash available right away. So if your offer is contingent upon a mortgage loan going through, then somebody else might have a more enticing offer, and they might have an upper hand on getting that house. So what a lot of people have been doing is leveraging the equity in their home to have a cash reserve and to have those funds ready for when they do find another property to purchase that they might want to move into, to be more competitive. Now let's talk about ways to fund a renovation or these additional uses for a loan that we talked about. So this isn't necessarily pertaining to only home renovations. You can use either a mortgage refinance or a line of credit or something else that we'll talk about to fund that debt consolidation or to have a cash reserve for funds to be used at your discretion for whatever reason you're thinking of using them for. So I'll backtrack a little bit. Let's talk about the benefits of a mortgage refinance, or what a mortgage refinance is. If you currently have a mortgage on your home and your interest rate that you're paying is above 4%, you may think about refinancing that mortgage into a lower interest rate, because over time, you will save money at an advantage with a lower interest rate. And with that mortgage refinance, what you could do is also get a cash out option. That means is, let's say your mortgage is $300,000 and you have a specific project in mind for your home, and it's going to cost $100,000. You would get what's called a mortgage cash out refinance. So you would refinance the $300,000 portion of your mortgage, and then you would receive an additional $100,000 for a new mortgage of $400,000. There are different terms and rates as well. So you could do a 15-year mortgage or a 30-year mortgage. That would be up to you to talk to your lending professional about what is the best to meet. There are other mortgage options as well. There's a 5-5 arm and things like that. Other alternatives to refinancing your mortgage or obtaining a home equity line of credit. For instance, if you have a smaller project in mind, or you think you only need maybe $5,000 to finish up the landscaping project and you're planning on paying it back in a year or something like that, there are unsecured lines of credit available as well. If you don't want to tie up the equity of your home, if you don't want to get your home appraised or go through all of that, the unsecured lines of credit are still competitive, but the interest rate is higher than if you were to get a mortgage or a home equity line of credit. You could obtain a credit card. Most credit cards have introductory offers where you could get 0% or a very low percentage for 1 year, for example. So if you have a smaller project in mind and you just want to finance that and plan to pay it off within a year, then a credit card might be the way to go. And again, you wouldn't be tying up the equity in your home. You could use your savings for that project that you're thinking about. And then there's also a renovation loan. So the difference between a home equity line of credit loan and the renovation loan is really the combined loan to value ratio. What a combined loan to value ratio is what your house is worth, what it appraises at the current market, versus the debt that you have outstanding against your home. So your mortgage plus the financing of the new loan. With a home, and we'll look at this at a future slide as well, so you'll see the projections broken up. With a home equity line of credit, up to 80% of a combined loan to value at most banks. At Burke and Herbert Bank, you can borrow up to 85% of that combined loan to value, and that's it. Whereas with a renovation loan, if you have a huge project in mind and you want to build an addition to your house, something that would cost more than the equity that you have in your house, a renovation loan would use the projected value of your home after the renovation has been complete. And that is what your loan would be based on. So you could potentially get more money for your larger project, and you would, in essence, get a mortgage, but for the projected value after the construction of your home has been complete. So all of these different options depend on what it is that you're trying to do with your project and what you have in mind. To delve more into a home equity line of credit, what a home equity line of credit does is it leverages the equity in your home to secure a credit line for other borrowing needs. The main difference between a home equity line of credit and a mortgage is that with a home equity line of credit, you can continuously borrow money up to $100,000. You can continuously keep using the line for up to the $100,000 like you would with a credit card. You're only responsible for making interest payments on the amount that you're using. So if you qualify for a line for $100,000 and you're not using it, it's just sitting there, great, you're not paying anything, but you have that money available should you need it. This is great for people who have multiple projects in mind or who haven't met with contractors yet or who don't really know how much they're going to need specifically for the project. So if you're thinking down the line and you're thinking about staying in your home for a while and right now you want to, it sounds enticing to get your kitchen remodeled, but maybe in a couple of years when you're done with the kitchen, you might be interested in remodeling your bathroom or something like that. Then a line of credit would be a good choice because you can always have access to those funds. If you were to obtain a mortgage, you would get a specific amount once, and then you would be repaying that amount going forward. So you wouldn't have access to more funds unless you refinance down the line. Okay. So, here's that example that I was talking about the combined loan to value and what that means. Now, this says this is a HELOC example, a home equity line of credit example, but this works for mortgages as well. And this is just how the equity in your home is leveraged to qualify you for a loan. It doesn't matter what you purchased your house for or when you bought it. We look at the appraised value as of right now when you're getting the loan. So right now, remember, the market is hot, the demand is huge for homes, and the higher the demand, the more value the homes appraise at. So let's say your house appraises at $500,000 and the mortgage that you owe on your home is $300,000 remaining principal. So what that means is you already have $200,000 of equity in your house. That's what you can use. That's what you've paid into it. That's your money. It's sitting there for you to borrow against. Now, remember, there are certain ratios. So for a home equity line of credit, we can lend up to 85% of your combined loan to value. So let's say we take the $300,000 that you owe for the mortgage, and you could potentially get a line of credit of $125,000, which would be total $425,000, which is 85% of 500,000. And again, you don't have to use the line of credit necessarily for home renovations. You can use it for any other consumer purpose you'd like. So you would have 125,000 sitting and available for college tuition, or to consolidate your debt, or whatever project you might be thinking about. Some things to consider in general. We'll talk about a home equity line of credit consideration first, and then after this slide, there will be one about mortgages. When you're thinking about getting a loan and shopping around for one, most banks are similar, but there are small differences that you may want to ask about or read about. So with a home equity line of credit, you want to think about whether you're getting a fixed or variable interest rate. With any home equity line of credit product, your interest rate is going to be variable. This is different from a mortgage. What the variable interest rate is based on is the Wall Street Journal prime rate. The Wall Street Journal prime rate, I'll read a definition to you, is defined by Wall Street Journal as the best rate posted by at least 70% of the nation's largest banks. The rate is dictated by changes from the Federal Reserve's Federal Open Market Committee. So it does not change on regular intervals. It changes only when the nation's largest banks decide on the need to rise or lower their base rate. To be honest with you, we never know when the interest rate will change. Sometimes it's the same for 4 or 5 years. Sometimes it increases 2 or 3 times within 1 year. So to keep in mind, with a home equity line of credit, there are many benefits, but they typically either a discount or there's a promotional period. So you might see a promotional period of a fixed interest rate for 1 year or so, and that's always helpful to ask about that as well. But for the majority lifetime of your loan, the interest rate would be variable. And we just talked about the frequency of rate adjustments. Nobody can predict how often it adjusts, but you could, if you're interested in it, you can Google Wall Street Journal prime rate. You can see what it is daily, and you can see the history of the Wall Street Journal prime rate and how it has changed. And also, when you do apply for a loan, there are certain disclosures that you receive, and those disclosures list what the Wall Street Journal prime rate was over the past 10 years. So you can have a calculation as well, and kind of think about what to expect. We talked about the amount and the length of the discount. Sometimes there is a monetary discount as well. We'll talk about the Burke and Herbert Bank home equity line of credit product in detail towards the end of the presentation. But for example, Burke and Herbert Bank offers a $1,500 credit towards your closing costs. And some banks do that as well, or different amounts. And we wanted to think about the interest rate caps and floors. So right now, the interest rate on approximate interest rate on a home equity line of credit product would be about 3.25%, which is what the Wall Street Journal prime rate is. And it doesn't typically get lower than that. So the floor would probably be around the same thing. The floor is the absolute lowest that you would ever pay in interest on a loan. And then the cap is the absolute maximum that the interest rate can go up to. And credit cards have similar terminology as well. You want to think about the length of the plan of the loan that you're getting, and that really depends on the project that you are thinking about. Again, we talked about whether you have something specific in mind, you know, this is what I'm doing, and at the end of this project, I'm going to have this, and I only need the money for the one project. Or maybe you want to renovate your kitchen now, and then your kids are going off to college in a few years, and you might want to have some money in reserve for an emergency. You never know what might happen. So things to think about like that. And initial fees. There is always going to be an appraisal with a home equity line of credit. There might not necessarily be an appraisal necessary for a mortgage refinance. So an appraisal is something that you would pay for out of pocket. Some banks have an application fee for a loan. Most do not. If we're talking about a mortgage refinance, that is where points come in. So a point is a percentage of the amount of the loan that you're getting. And typically with closing costs for a mortgage, this is only pertaining to mortgages, you would pay between 1 to 3 points, which means you pay between 1 to 3% of the total amount that you're getting financed. That's why with a mortgage, the closing costs are typically higher than with a different type of loan. But there are benefits to getting a mortgage loan as well, or refinancing your mortgage loan. And then the repayment terms. So for example, with Burke and Herbert Bank, you can pay towards the principal of the amount that you borrow at any time. You can pay your loan down to a zero balance if you want to, and there is no penalty for that. But some banks might have, or some products might have some sort of term where you have to keep a balance for a specific amount of time. Otherwise, you have to pay a fee, something like that. Now, with mortgage refinance, you're getting a little in a mortgage refinance, especially if your interest rate is above 4% on your mortgage right now, is saving money in the long term. You are going to reduce the interest rate, and out of all the lending products, a mortgage is going to give you the lowest interest rate available currently out of lending products. With a mortgage, you are only going to receive the amount that you apply for once. So your mortgage is $300,000 currently, you're going to refinance it, and you have a project in mind, so you're going to get $100,000 cash out. So your total mortgage will be for $400,000, and that's it. You can't borrow further down the line, but you're going to get a locked-in fixed rate. So right now, the interest rates are very low. So to lock in a fixed rate of 3% is fantastic down the line. You wouldn't be paying much more than your actual mortgage is for. And it also depends on how long, if you're thinking about getting a mortgage or a mortgage refinance, it also depends on how long you plan to stay in the house. This is an investment over a longer period of time, so it would only be worth it for you to make the closing cost payments for a mortgage refinance if you're planning on staying in your home for at least 3 or 4 more years. Otherwise, if you're planning on just selling it in a shorter time frame, you might not be able to reap the benefits of the lower interest rate because it is over 15 or 30 years that you would be feeling that. And then also the cost of the refinance, the current rate. Generally, a good rule of thumb is if you can save 1% of an interest rate from what you currently have, then it's worth it. But if you already have a mortgage interest rate of, let's say, 3.5% or something, it probably would not be worth it to refinance just to save a quarter or 0.5% of an interest rate. Again, length of time you plan to stay in your house, and whether you need one lump sum for a specific project or a specific need, or if you plan on going back and using the funds over and over for a period of time. So cash out mortgage refinance versus a home equity line of credit. We just talked about this briefly, but you can see the pros and the cons. So this is pros and cons for a cash out mortgage. The major pros that you get a fixed interest rate. There are more programs available for those of you who might not have the best credit, and we'll talk about what goes into a credit score a little bit later on and things that are required to qualify for any of these loans. But with a mortgage, there are more programs available. There are usually lower credit expectations, and it's easier to qualify for folks to get a mortgage over other types of loans. You may qualify for a higher amount in some instances, and that's really pertaining to that home renovation loan I was talking about. So if you have maybe let's say you're purchasing a house and it's an old home, all the houses, majority of the houses in Northern Virginia are very old, so you already know that I'm going to buy a significant renovation, home renovation loan on the type of mortgage. Mortgages tend to go up to 95 or 97% of a combined loan to value. So you could potentially get a bit more money for of a combined, potentially maximize the equity in your house. Always, typically a home equity line of credit will go into a second lien position behind a mortgage. So banks are not as lenient to lend as much for that specific product, because it puts a bank in a different type of position. And the cons to mortgage refinance would be higher closing costs. I'll have a comparison for you, I think, in the next slide. Your monthly payments would be higher. So with a home equity line of credit, you're only responsible for making interest payments on the amount that you're using. So imagine every month you're paying interest only. You can pay more towards the principal if you would like, but you don't have to. With a mortgage, you get a set amount and you get a set payment either in 15 years classic mortgage term. So you'd be paying your principal and interest, and then also not necessarily but almost all the payment, the escrow. The escrow is a combination of your property taxes and your homeowner's insurance, and the mortgage will have that as a payment as well. So your monthly payment would be slow and steady. And the con to a mortgage refinance is the funds wouldn't be available after the one time that you got that cash out. So a projected closing cost, let's say your mortgage is for $300,000 and you get an additional $100,000 cash out. So your total finance of this new mortgage loan is $400,000. An estimation of closing costs in the Virginia area for that would be about $4,500. That's not including the escrow, which we said was the property tax and homeowner's insurance costs. Oftentimes, banks require you, when you obtain a mortgage, to pay at least 2 months of those, what those fees would be up front, what the cost of your property taxes and homeowner's insurance would be. Some require 6 months up front, so that would be an additional cost at the very beginning of obtaining your loan. And you would get that money back eventually. But if you're thinking about financing something, then it might be a little bit tough to get that money together. With a home equity line of credit, you don't need to touch your mortgage. You keep that as it is, and you just get the amount that you are looking for, the new loan amount that you need for your project or other endeavors. So for a $100,000 home equity line of credit, your estimated closing costs in Virginia would be about $1,000. And it's very similar in the DC and Maryland areas as well. Now, not all banks do this, but not all banks do this, but the Burke and Herbert Bank for you. So to obtain dollars, it really would be an appraisal. Now, when you are ready to apply for any type of loan, here are some just basic items that you may need. You do need to have an ID. You would need to provide your monthly mortgage statement, your most recent one. Your mortgage would need to be current. So you can't be late on any payments that you currently have. And that ties into a healthy credit score, which we'll touch base on in a little bit. And you would also need proof of income. So for any loan that you apply for, a general rule of thumb is that you need to have been employed for at least 2 consecutive years in order to qualify. But it doesn't have to be at the same job, it just has to be for 2 consecutive years. You would be asked to provide proof of your homeowner's insurance policy, and depending on situations and depending on your financial picture, you may be required to provide tax returns or some other items. Now let's talk about your credit score and what it's comprised of and what a healthy credit score looks like. There are several major credit bureaus who calculate your scores, and I won't go into the scores because they're different for each credit bureau. But basically, when we're looking at the credit score, here's what it's made up of: your payment history, your outstanding debt, your credit history, types of credit in use, and credit inquiries. And a side note for these credit inquiries, if you are applying for multiple loans simultaneously, your credit score will go down for a short period of time, because the more creditors inquire about it, the more dings it gets. So if you're thinking about purchasing a house, or if you're thinking about applying for a home, or if you're thinking to research the product first, don't actually apply until you are sure that that's who you want to go with, because your credit score will be temporarily affected. Key considerations of financing. So we touched base about this. Again, the difference between a home equity line of credit versus getting a mortgage cash out refinance. With a home equity line of credit, you get the added flexibility of having access to those funds over and over, whereas with a cash out refinance, you get the financing once and you can't have access to more funds unless you refinance again. And now I will tell you about the product at Burke and Herbert Bank that we offer. If you'd like to speak with me further about other items that we offer, other programs, please feel free to reach out. We do offer credit cards, we offer unsecured lines of credit and installment loans, and things like that. We offer loans secured by a savings account or a certificate of deposit. But today I will tell you specifically about our home equity line of credit product. So the Burke and Herbert Bank home equity line of credit product is a 25-year loan. You can use the line of credit, you can advance on the amount that you qualify for the first 10 years. For those 10 years, you're only responsible for making interest-only payments on the amount that you are using. You can always pay more towards the principal, as we talked about, but you don't have to, and there is no penalty for it if you do want to. After 10 years, if you still need a line of credit, we can always refinance you at that point into whatever product we're offering at the time. If you don't need a line of credit anymore, but you have a balance remaining, then we'll break up the balance into principal and interest payments for an additional 15 years. So you're not going to have to pay that full balance all at once. We do offer $1,500 credit towards your closing costs. And the only caveat with that is that you keep the loan open for 3 years. If you close the loan within the first 3 years, you will be responsible for repaying the closing costs back to Burke and Herbert Bank. Now, that doesn't mean that you have to keep a balance for those 3 years, and that's absolutely fine. The interest rates that we have vary on the amount of the loan that you qualify for. Our best interest rate starts at a loan of $100,000 or higher, and that interest rate is the Wall Street Journal prime rate, which we talked about was currently 3.25%, plus a quarter. We discount 1/4% if you set up automatic payments from a Burke and Herbert Bank account. So you could potentially be receiving an interest rate of 3.25%, but now again, that is variable, so it is subject to change. We have an additional promotion of if you would like to advance at least $20,000 at the time of your settlement. So if you have a project in mind, you're ready for the funds to use like yesterday, we can advance at least $20,000 or more at the time of your settlement. And if you have at least a $20,000 balance for the first 6 months, then you will qualify for a promotional interest rate of 2.25% for the first year. So that's where you want to evaluate whether a bank offers a promotional interest rate and what the interest rate is after that and when the promotional period ends, things like that. So thank you very much. Now it is 12:46, so I'll be happy to take any questions if we have any.
Yes, thank you so much, Liz. We have one question here because we are kind of close to the time that we have to give it up. What can I do if I don't work more than 2 years? Can my son borrow money for me?
You can always speak with a lender, and there are many options. You can absolutely get a co-borrower, and it depends on your situation as well. Were you laid off because of the pandemic? Did you work before that, or did you not work for 5 years and then you just entered the workforce again? Having your son or somebody else act as a co-borrower is a fantastic idea. I'm giving you general guidelines, but there are always exceptions that can be made, and a lender and underwriters will work with you with your specific situation to put the loan in place and make it happen as much as we possibly can. So I encourage you to apply, or you're welcome to reach out to me afterwards. My information is on this next slide here. Please give me a call or send me an email, and I'll be happy to go over different options with you and what you can do.
Great. One more question. Do you loan to second homes for the ELOC? Is that available for a second home?
It is. For a home equity line of credit product specifically, and again, this is just for Burke and Herbert Bank, because every bank is a little bit different, but for Burke and Herbert Bank, we can put a home equity line of credit on your second home as long as it is truly used as a second home and you're not using it as an investment property, so you're not renting it out. But if you are renting it out and you are using it as an investment, then we can put a mortgage on it. But for the home equity line of credit product, it does need to be truly a second house.
Great. Okay, Liz, give you 30 seconds for you to say the last word, and then we'll close the class.
Oh, well, I'm sorry I took up so much time. Thank you very much for joining me. And again, my contact information is up on this screen. Please don't hesitate to reach out. And even if you're not sure whether you're interested in a home equity line of credit or a mortgage refinance or something else, I can at least put you in touch with the right lender and the right person to speak with. Thank you very much.
Thank you, Liz. And everybody in the chat, we have the link for the Burke and Herbert exhibit. They have an exhibit landing page here. Please, come back. We're going to record. We're recording this presentation, and it was a little bit cuts on there from Liz, but just forgive us, please, and see you in the next workshop. Thank you, Liz. Bye-bye.
Thank you. Bye-bye.